All right. Welcome, everyone. Today's presentation, obviously Thursday, 7/23. We are going to be covering, as usual, quite a bit today. I received several more emails with trade setups and trade questions, which I very, very much appreciate, and that definitely helps me direct how these calls go, and it also is helping me direct how I am focused on some of this material for the upcoming seminar. And so if I have not responded personally to your email, just please bear with me. I will, because I do appreciate that stuff being sent to me. And I will, specifically address each of these trades. I can't address each of them in the calls. There's just too many, but I have no problem addressing them to you via email. But some of the material that I am getting, I'm seeing repeated errors or repeated mistakes or repeated misconceptions about how the trades are being placed and what you're doing and all that stuff. And so when I see a pattern with that, clearly I need to do a better job of addressing that particular situation, that particular understanding or piece of information or whatever. So that's what helps me do that. Again, I have been neck deep in seminar material. It's getting better every day. There's an old song that says something about that. Anyway, I am neck deep in seminar material, and I'm making a few changes. I'm making a few additions. I'm clarifying certain ways, et cetera, et cetera. And I am really excited about this thing. This is our second to last. Monday will be our last live session together before the seminar starts. The next live session next week will be on a Friday, not Thursday, and it will be during the afternoon of Friday during the seminar, so that everybody attending the seminar can also attend that live session. So I'll have one more normal live session, and then we will be off and running with the seminar. And after that, there won't be any live sessions. So I do want to remind you of that for the next 2 weeks. Sorry, not forever, just for 2 weeks, because I will be out of pocket trying to get a little R&R. This thing is preparation for this has kept me up at all hours of the night, and it's quite the undertaking. Nonetheless, if you're not signed up for the seminar, my goodness, you need to get signed up for the seminar. If you are not a yearly subscriber, that's what you need to do first, because you get a massive discount on the seminar. So call Spring and get that done. Again, it starts on Friday. We start Friday morning, 9 a.m. Eastern, and that will be the first session. And then we'll go throughout much of the day Friday, and then again much of the day on Saturday, dealing with a whole bunch of different stuff. All right, so for those who are new to the call, if this is your first TPO Live Trade call, I do want to welcome you. However, I do want to also caution you that if you're expecting to attend this call and immediately understand everything that we're talking about and everything that we're doing, it's impossible. I can't explain everything about these trades in one call, and you're certainly not going to understand everything about them in one call. However, you should understand enough to see the kind of probabilities that we are dealing with these trades. And so along those lines, I do want to welcome you, but I also want to warn you that as you get further and further into this and you start taking trades, you need to start small. You do not start multiple contracts, big trades. You're not looking to make a killing in the market. You start small. You don't want to be reckless with how you put these together, and I will, and that is being basically on display this week of why you don't want to be reckless with these things. And then you definitely want to follow instructions. And in the seminar, I have a blueprint, and it is a very good blueprint. And it's called my TPO $1 million blueprint. And it's basically the instructions on how to implement the information. You're going to want to follow that blueprint, follow the instructions to a T, and that gives you the highest probability of success. If you don't follow the instructions, who knows what's going to happen? You can make mistakes. Obviously, there are instructions in there specifically because there are traps, there are gotchas, there are mistakes that can be made with these strategies, and they can definitely knock you back a bit. And these instructions are valid whether you are brand new to trading or whether you have extensive experience. No one on this call has more experience trading these types of approaches than I do because I created them. And several weeks ago, 4, 5, 6 weeks ago, I forget what it was now, I didn't follow my own instructions and it came back and bit me. So they even apply to me. So if they apply to me, they obviously are going to apply to you as well. So don't discount these instructions. Great trades doesn't mean you can throw caution to the wind, because great trades don't always turn out great. So one of the reasons I talk about starting small, and again, if you're not new to these calls, I focus on this because this has to be your focus. Money management, compounding has to be your focus. If you can get to where you're averaging $100 a week, you can grow your account very, very, very quickly. We're talking about $30,000 in 6 months, regardless of where you start, $30,000 in profits in 6 months by starting with one unit and then increasing. If you can average that going out to 5 years, you're talking about 3.4 million, and that's based on a conservative compounding plan. Now, you're not going to start off making $100 a week, because that's not our goal. Our goal is to start making anything a week, basically $10 a week, $20 a week. That's your goal, and that's average. You're not going to do that every week, and there are going to be some weeks where you do better than that, obviously. So that's average. And if you can do that, you're talking about massive growth in your account. And of course, what our goal is to start making a little bit of money and then add to it, making a little bit of money and then add to it. All right, so having said that, let's get into the topic of today. And originally my topic, well, this is the topic, and it's very similar to the last call because I received a lot of emails and a lot of calls on this. And so apparently I wasn't crystal clear in what I was doing or how I was doing it. And so I do want to spend a little time on that today. Obviously, we were in some trades, and prior, even this morning, those trades were basically in the money to some degree, and they are now not in the money because the market has cratered today, which, by the way, something that you can pack away in your little notebook somewhere. If we are up Monday, and we're up Tuesday, and we're up Wednesday, and we aren't down Thursday morning, we can be up a little, we can be flat, we can be up. The probability of a reversal on Thursday afternoon is very, very high. So this was actually, I actually took some trades this morning because of that 3-day pattern. This has nothing to do with the TPO patterns. It is a cyclical price action pattern based on seasonal and cyclical aspects. So you can pack that in your notebook somewhere to look for those, because I do use them from time to time, and I used it today to put on some TPO patterns this morning, even though they close out tomorrow. But I focused on bearish TPO patterns to help enhance my trades this week based on that. So that's how I use it. Nonetheless, the market has come down significantly since this morning, about 5 points basically. And because of that, our trades are making money. So the first one I'm going to bring in is before we get to the information today. So the first one I'm going to bring in is this one, and this has been a kind of a weird week, but nonetheless, I was filled on this, I believe, on Monday's call on the bearish, and I had these two different bullish trades going out, and I said, okay, we're gonna watch these two different bullish trades to see where they go. All right, so we did order one at a credit of 120. This is now out of the money, so we know that that's going to be at least worth zero. So we have another $35 worth of profit on that. So we're making about $83 on that trade. I then had these bullish trades on, and I said I was going to wait for a better price on the bullish trades. So here's order 2 and then order 4. I did not do order 3. Okay, so I did order 2 and order 4. And both of those have tanked. I actually did not get filled on these until this morning. And so both of these, order 2 and order 4, I did not take order 3, if you'll recall. I did order 2 and order 4. And no, so those are losing about $80. And again, this is at a credit of 0. So I was filled at 120, and then I was filled on the bullish, the first bullish of 60 and the second bullish of 60. And the only reason I did that is to compare the two different types of bullish trades. So this is just the 2-lot order, right? And that's 31. It's a short 331 strike, and then a long 329. And filled at 60. It was trading about 70 when we placed the order, and then it immediately went up. If you recall, Monday the market immediately went up. So that one is now trading at 28. So we're losing about $30 on that one, and we're losing about $35 on order 4. And so we're losing about $65 on that one and making about $90 now on order 1. So I could right now take this and exit at a profit. This is the first time since I put this trade on Monday that a profit has been available. Okay, now I could have, because these orders, these bullish orders, were not bullish or filled. Excuse me, they were not filled until this morning. And knowing what I know, I could have said, you know what, I'm going to cancel those because I have a higher probability of possibly taking a profit on the bearish trade or getting in at an even cheaper price if we do see a market move down. I didn't. I kept them in for the sake of this call, and that's basically where we're at. Is we are losing $60-ish on those and making about $83 on the bearish. I could take this is the first time I've been able to take a profit on this trade. The market moved higher, even though it did not move out of the money. This bearish trade held on to its value. And even now, the 324s, which are 2 points out of the money, expire tomorrow. You know, basically one full trading day left, or still at a dollar. Right. So there's still quite a bit of profit available on this, and I'm because of this, I will hold on to this trade. If I were doing this trade and I was following if I was at the beginning of my plan, I would get out of this trade. And so I would take a 30, I would try and get a $30 profit out of this trade and be done with it. You know, especially if this was my first trade. You know, on the flip side of this particular bearish trade, if you'll recall, if you got into the bearish trade first, you would have had to accept the risk of this bearish trade. And I say bearish, it was bearish neutral. You would have had to have accepted the risk of this bearish neutral trade. And then wait for the bullish trades to get filled. Okay, that's not necessarily the best way to start the plan. And a better way to start the plan is to get filled on a bearish and then get filled on a bullish as close as you can possibly get filled on the bullish, and then put a better price in on the second bullish. So for example, I would say, fill me at $1.20 on the bearish, and then get me filled on a bullish wherever that is. I wouldn't necessarily go market, but I would work the price. Okay, that would be the best way to get into that, and then you could lower the number on the second one. The other way is to get into the bullish first, wherever it may be. And so at the time, I think we could have gotten in at 70, and then get filled on the bearish at, let's say, 130 or 140, and put a limit order in to get filled on the bearish. Now you're taking a risk on the bullish by doing that, but that's a smaller risk, higher probability, but smaller risk than the bearish neutral. The bearish neutral trade had a lower probability of realizing the risk, but it also had a bigger risk. So there's some confusion on how to do that. And in worst case scenario, this was on Monday. I strongly suggest trying to get into this type of trade on Thursday or Friday. And that way that will do something, be easier to get a better price on these. But one reason I was willing to wait for the bullish on these is because the market was trading higher. And again, we are a hair away from all-time highs, and the data just doesn't support it. And we've made a pretty big move up during July. And so because of that, I was willing to be a little bit more aggressive on the bearish side when the market was up on Monday. You can take all those factors, but the bottom line is you got to make sure that you're willing to risk, however it is that you do it, you need to be willing to risk the single order if you don't, or if you can't get both trades on at the same price, or if you can get them on but it's a small debit, you have to risk that as well. But another reason that I was a little bit more cautious this week with doing that is because as the market is moving higher, up until today, it's been moving higher, the volatility will continue to come out at breakneck speeds by Friday's close. And so because of that, I knew that if the market moved up and I put my bullish trades too far away, then it would be very difficult for me to close out at a profit the closer we got to the expiration. Not impossible, but difficult, and my profit would be smaller. And so all of those things come into play. I have on this particular pattern, I have an entire session that I spend in the seminar on this pattern, going over all of these different little things that will help you improve your overall execution of them. They're in the blueprint, like a checklist, a checkpoint of things that you might consider as you're putting on this trade, with full explanation. And so I think that'll help a lot as we move forward. So getting out of these trades is a little bit more difficult because they are moving, right? And you can't get out at the same time. So I cover this more in the seminar as well, and I'll be covering this more after the seminar in the calls, mainly on Thursdays calls. But so, for example, the one thing that you're going to see is that you're going to see that the bearish moves quicker than the bullish. Okay, the bearish neutral moves quicker than the bullish trades. The bearish can actually go to a debit, and will go to a debit if the market closes between here and 324. This will go to a debit, which means that my profit potential is bigger than my credit. Okay, these will not go to a credit. My bullish will not go to a credit. The best they can do is zero. Therefore, the lower, the closer to zero it goes, the harder it is for it to continue moving down. And so what I would do in this instance, for example, I would I would put an exit order for 20 cents. Okay, and it would be an exit order of 20 cents on the bearish, and then I would turn around and I would get out of these for as much as I possibly can. It would be approximately 50 cents total, and that would give me a $30 gain. Okay, the risk of doing that, if I put my credit in, okay, I'm going to get out at $1 profit, which means a 20-cent debit. Okay, when I go to exit, this will switch to a debit. The spread itself will go to a debit after there's additional time value that drops off of these calls. Okay, so I don't want to confuse people with that, but let me show you what I mean. I'm going to do a reversal. So here's how I would do it. Buy to close 724, buy to close 724, sell to close 727. Same thing, so I just did a reversal. That's what these blue lines are. Okay, let me hover over that. It says duplicate inverse. So if I want to exit the spread, it will go ahead and fill that out. So now it's buy to close, sell to close, okay? You'll notice this is now trading at a debit. That's trading at a debit because I've reversed what I'm doing. And don't let that confuse you. But that's what it does. Personally, I don't like IB. In fact, I hate IB, but I do like the fact that they don't switch the price of the spread. They either say you're going to buy the spread or you're going to sell the spread, and that's it. And this price stays the same. So if it's a credit, you're going to buy at a credit, and if you're going to exit, you're going to sell it at a credit. They're not going to switch the prices. So different brokers display it differently, and Tradier requires that it be displayed as a debit when you go to exit it. And technically that is correct. My preference is that you don't switch the prices, because I'm always, then you have to switch, how you look at the profit in your brain. So if this price up here goes to a debit, my sell to open, buy to open. If this price up here goes to a debit, that means I'm making more than my credit of 120. Okay, that's what that means. When I go to exit, if I have a debit here, I'm in at a credit of 120 and I get out at a debit of 30, that means I'm making $90. That's how that works. So I would put in an order to exit this at a 20-cent debit. Okay, that's how I would take $1 credit. Now, in the smart order, I could say as soon as that's filled, go ahead and get me out of the bullish. Get me out of the order 4, get me out of order 2, which are now going for 62 cents. So this is now trading at about a $40 profit. And then that would take my profit, and that's that. Okay, so that's how I exit those. All right. So the next one that I got was more in the money. It was a 323. Let's see, what is this one? This is a 320. Oh yeah, just slightly more in the money. So it's a 323, 326, 327. Filled at $1, and then I got into 2 bullish. This was last week. Then I got into 2 bullish at 60 cents. So I actually took a 20-cent debit on the trade. Let me find, where is that? Well, long story short, that one is trading at, the bearish is trading at at 50-cent profit, and I'm losing 30 cents on my bullish. So that's trading at a 20-cent debit, $20 debit. And hang on, and I will find it. 23, 26. Oh, here it is. Oh, so let me give you the screenshot because I don't know which. I have so many of these open. So hang on one second, and we'll cover that one. Maybe. And it's not letting me do it. Well, hang on. Maybe this will work. All right, so I'm going to hack that one in there. Okay. So here is the trade right before the call. I can't find the open window, but just doing a quick math on the calculations. This was this first one was filled at $1 credit, and right before the call, you saw the market was trading at 324. Above 324 is trading at a credit of 131, so I was losing 31 cents. My bullish, I was filled on 2 of them at 60 cents, and so I was making 24 cents. So on this one as well, I have yet, until a few minutes ago, be able to take a profit on this one. Even though the market was trading pretty much below 327 the whole time, but we weren't quite into the profit zone, which is around 328. So this one, I should have, in normal circumstances, I should have been able to take a net profit on this one sooner than it was available, and they held on to the extrinsic value for longer than normal this week. This morning, especially, I was expecting if we traded around 326 that I would start to see a profit in this combination, but I didn't. I continued to see a small loss. I think the loss on this trade was like at $20. So they don't work out the same every single week. And this one was a little bit more a little bit more conservative than normal. And so even though we had not moved through the profit zone yet, I was not looking at an open position profit until a few minutes ago. And the open position profit right now is about $20, and that's it. But again, this whole thing, this 323 right now is completely out of the money. And so it's trading right now at a credit of about 50, and it's completely out of the money. And it's only trading at a credit of 50. It should be trading lower than that in normal circumstances. So it doesn't work out exactly the same all the time, but again, again, we're dealing with high probability trades. So eventually, even though it took longer, eventually there is the probability, very high probability, that you will be able to exit these at a profit. Even though it's going to be small sometimes, and you might have to wait a little bit longer sometimes. Okay. All right. So whoops, I'm going to get rid of this one. And let's move on to the topic, and then we'll take a trade for next week. So comparing now trades versus next week's trades. Again, I covered this Monday. Apparently wasn't quite clear, but it's very helpful, very useful information. One of the things I talk about is putting together trades that give you the highest probability of taking an exit during multiple times during the week. And so, for example, my example for that was this week's trades. And I wasn't able to take a profit until today, until actually this call, if I wanted to do that. And so, sometimes, again, there are multiple exits that occur more than other times, but we want to stay away from trades that only provide a profit potential right before the close on the last day. And my most simple example is a calendar spread. Calendar spreads are great sometimes for boosting up the dead zone in an area, to cheaply boost up a dead zone in an area. But the problem with calendar spreads is you literally have to wait until like the last hour to see it reach the maximum profit potential. And the problem is that only occurs at that strike point, right? So either on the right side or the left side, it's not going to have as big of a profit. And so that's one simple example of a trade that is very difficult to take a profit on during the week of any kind of any substance. All right. But what we're going to do is we're going to go a little bit more complex with the trade example that I'm going to use, because it can be super tricky sometimes due to ridiculous volatility drops. And I was expecting more of a volatility drop this morning than occurred. On tomorrow's options, it didn't happen as quickly as I thought it might. And then obviously, especially on Fridays. By the way, on these trades, there's no way that I would be holding on to these trades past tomorrow morning. I would say before 10 o'clock Eastern. 11 o'clock Eastern would be the max hour that I hold on to these trades. And I probably, I'll take a look at them before the close today, and I'll decide whether I get out or whether I hedge on these trades. So the volatility can be tricky. When in doubt, if you're at a profit, when in doubt, take the profit. That's what I would do, and just bank the profit for the week. Go on to the next trade. Average your $20. Get to where you're averaging $20. Watch the trade after you exit it. Was it a good exit? Was it not a good exit? Could you have done a lot better, et cetera, et cetera? And then you can make those decisions. A little bit better, and a little bit better, a little bit better. So you do have to be careful, but this is the process that I go through. So this is what's called my bubble trade. You'll see this in the seminar. This is really more for when the volatility is a little bit higher. And when the volatility is a little bit higher, you can usually get a little bit better price, and you can expect the bubble to actually produce a bigger profit than what you can expect the bubble to produce in current market situations. Right, so a bubble trade is very similar to what we've been doing, only I've got my bullish closer to the bearish neutral. And so it's actually a bullish neutral to some degree. And, with this combination, I'm squishing the strikes closer together. If you want to create a visual of what's happening. If you recall, the further away the short strikes are, the further away the profit peaks are. If you can bring those short strikes closer, you're going to close the gap, and you're going to eliminate the risk of a dead zone going negative. All right. You don't eliminate the risk of the profit potential dropping as volatility drops and as you go into the close, but you do risk the dead zone situation, or you do eliminate the dead zone risk. So this is what it looks like. And you can see here the profit peaks. Here's one profit peak, here's two profit peaks, here's a third profit peak. Okay, everybody see where those profit peaks are? Those are where the shorts are. And that short, these shorts are what creates the dead zone, or the distance between these shorts is what creates the dead zone. And when you have basically only 3 strikes between the shorts, which is equal on both of these, then you have a situation where that dead zone doesn't have room to sag, right, in between, I should say. And so it creates a bubble. It creates a bigger profit potential in the middle. But then you have a little bit more risk on the trade, and on this particular trade, you have I forget what the exact strike difference is, but you have a risk that eventually gets to about $200. And this is a trade that was at a 2-cent credit. It was placed at a 2-cent credit. So my bearish and my bullish combined was placed at a 2-cent credit. Okay. If that's what it looks like, where is it now? At a 2-cent credit, I entered at a 2-cent credit. Here's my bearish at 17 cents. Here's my bullish at 68 cents. And I only did one because the bullish costs more money, and I could only do one and still create a credit. And so now, this was placed last week when the market was trading around 322, 323. All right, so here, the market was trading around 322, 323 when I was able to place on this bubble trade. But now you have the bullish at 68 cents and the bearish at 17 cents. That gives you a total debit of 51 cents. So this trade, placed on at a credit of 2 cents last week, had, when the market was trading at 324.41, had a profit of $51, $53 technically. All right. So I know from 1 week to the next, as long as the market doesn't trade too far up here, I should be able to exit this trade at some point in this range at a profit. $20 is all I'm looking for. $30 would be great. $40 would be great. $50 would be ecstatic. But you know, it's a trade that you can definitely place and create that high probability scenario as long as you place it on, you know, when the market has to move through the profit zone, right? Now, if the market were to go from 322 to 332 in one day, which we've all seen this happen. It happened during this call on a Thursday when the market moved up after the announcement, after the unemployment announcement. That's when I got dinged pretty bad for not following my own instructions. I said, there's no way it's going to go 10 points in one day, but that's exactly what it did. So, you know, there is a risk of this jumping the profit zone, but how often is that going to happen? Not going to happen often. So, you know, even if it does happen, though, you have to accept the risk on the trade, which is why you follow the compounding. Nonetheless, as it's going through here, at some point, it's going to start to show a profit. Most of the time. And so this week, for example, 324, and that puts this bearish and the bullish out of the money, and it's trading at a profit of $50. And that's on a Thursday morning. Okay. Here is a look at this week's trade versus the same exact trade for next week. Now, this trade here was actually placed on at a credit yesterday of 10 cents. So next week is 731, 731.83, right? Strikes are exactly the same side by side. So order 1 is equivalent to order 3, only it's next week. Order 2 is the bullish, and order 4 is the bullish, only it's next week. All right, so right before the call, market trading at 324.42. It's at a credit of 102, and the bullish is at 111. That's a debit of 09. And again, yesterday, and you could have actually gotten this same exact trade on this morning at a credit of 10 cents. And so this one, if the market goes nowhere, market's trading at 324. If the market goes nowhere, then this trade should go from a 9-cent debit today to a 51-cent debit next Thursday morning-ish, if the market goes nowhere. Now remember, we're at 324 right now. The profit peaks are way up here. All right, so there should be ample opportunity to get out of a profit if the market is moving up, if the market is stagnant in between these profit peaks, or maybe going towards the third profit peak. So there's a large range here where if the market's trading, anywhere in this, you should be able to take a profit at some point. So it's a high probability. Okay, it's not as great as as our normal trade, our normal $1 million option pattern trade, because the risk is more in this one. The max risk in the $1 million option pattern trade is about $100. Sometimes a little less. If you get it for a debit, it's sometimes a little more. But because of the strike differences in the relationships, it's always going to be right around $100. Well, this one, if you get it at a credit, is going to be around $200. That's going to be the risk of this particular trade, but you have a higher probability of taking a bigger profit. And so it's something that you can add to it, once you are a little bit more comfortable. But again, if you look at this week's versus next week's, then we know, all right, the market going nowhere, and we should be able to exit at a profit. What about if it goes in the money? What about if it goes in the money significantly, like all the way up to, let's say, 330? What happens then? Well, there's a couple of things that happen. Number one, you've got a situation where they're going to start taking the volatility down a little bit more, right? But now we're at the very last profit peak. So we're substantially higher than where we were when we placed the trade on. And so here is, again, market basically trading at the same time. Here is the in the money. Okay, if we got in the trade at a 9-cent debit, okay, if that's what we got in, again, I didn't. I got into this trade for next week at a 10-cent debit, and I got into this week's trade at a 2-cent debit. So if that happens and the market moves into the money, look at the current in the money bubble trade, if you will. Again, so I'm referring to these as names. I'm referring to the patterns as names, so it makes it easier to reference as you're going through this stuff, and so everybody knows exactly what I'm talking about. You don't have to go and see, okay, which relationship is this with the strikes? Well, this is the bubble pattern, so you know what the relationship is. And so this is trading at a 17-cent debit right now, and it was in the money. If I had gotten into it at a 2-cent credit, guess what? I'm at nearly a $20 profit. And there were several times this week where this was actually at more than a $20 profit as it's going to that. So this is at the very end of the situation. However, if I were to go in the money for next week's, so again, same trade, order 5 is equivalent to order 7, only 1 week later. Order 6 is the bullish trade, is equivalent to order 8, only 1 week later. And it's trading at a credit of 25 cents. And that means that the risk is $175, not $200 max if SPY skyrockets. But we are closer to that risk level, right? But it's at next week's trade is at a 25-cent credit. So again, if I put this on right at the edge, and the market moves stays the same, then I'm making about $43 on this trade. So if I felt like I wanted to do a bearish trade or a more bearish leaning trade, let's say I'm fairly bullish in my current positions, and I wanted to add on profit stack, whatever the case is, a more bearish leaning trade, then I could put that on for a credit of 25 cents. And if the market goes nowhere, I should be making about $40 come next week, 1 week away. And if the market moves down, then it will be moving through my profit zone to the downside. And this is what that looks like. Okay. So this is based on the trade right now at a credit of 25 cents. The max risk is, I believe, $175 because of the 25-cent credit. And right now, even though we're trading at the break-even level, or actually The 324-ish was right here, 324.40. So we're trading below where this is showing. But right here, it was showing an open position profit of $40. Okay, so if at any time between now and next week the market moved down into the profit zone, I would have a pretty high probability of taking a profit. If it moved up, obviously, I would have to take the risk. So on this one, the probability is not near as high. It does, however, have a positive EMR. So if the market moves down, and again, we got in, let's say, at just above 324. So if the market moved down a full point, then you would still be making money. If the market moved down 2 full points, then you'd be losing about $50. Whereas if the market moved up 1 point, you'd be making, assuming that the volatility stays the same, it's not going to, it's going to come down, but you'll be making more than $100. And if it moves up 2 points, you'll be making a little more than that, because you're closer to the profit peak, right? So you have an EMR that is positive, but the probability of success is right at about 50% at that point. So not the best scenario in the world if this is the trade you take, because you're so close to the risk, but that just goes to show that you can take a look at this week's trades right now and where they're priced at and compare them to next week's trades to see whether you have a high probability of making money if the market goes nowhere or moves up or whatever. All right, so let's take a look at this. I think I have it here where it's at now. The market's trading at 322.50. Here it is. Hang on, I'm going to bring it down here. All right. So let's see here. Here's this week's bubble trade. 326, 328, 329 is now trading at a 10-cent debit. And my bullish is trading at a 40-cent debit. So that's basically 48-cent debit. So I basically have a $55 to $60 profit on this trade now that the market is trading even further down. This is, again, the same exact trade. The next week's trade is now trading at about a 15-cent debit, 11-cent debit. And again, that's it's currently out of the money. 326, and we're trading at 322. And then if I wanted to go in the money, that trade is now trading at a 63-cent debit. Order 5 and 6. That trade is now trading at a 63-cent debit. So 67-cent debit now. So that one is making money. And if you recall, if I got into this one at a 25-cent credit, and it's now trading at a 60-cent debit, I'm making $80 on this trade. And it's basically right in the middle of, actually it's not right in the middle. It's a little bit to the right of the second profit peak. A little bit to the right of the second profit peak, okay? And then if I wanted to go take a look at the current one that's in the money, it is still trading at a credit of about 120, about 20 cents, a little less than 20 cents. And so I could go, 320, 322, 323, and it's trading at a 20-cent credit. And again, the in the money by next week, trading at a 60-cent debit. So that'd be an $80 profit if the market goes nowhere and stays here during the week. If it moves down, I know I'd be making money. If it moves up, I know I'd be making money to a certain degree. That's how I compare the different prices. So if I want to look at, if I'm considering a different pattern, for example, and I want to I want to see where I should be trading at a week from now. If the market stays the same, if it goes down, or if it goes up. What I want to do is I want to put it in the money, and that represents the market moving up, right? So that's this one in the money. 320, 322, 323. It was in the money further earlier today. It's not as far in the money today now, but you get the idea. If I can get that same pattern at a credit of 20 and hold on to it, I know that if the market moves up, I should be able to make a little bit of money. If the market moves down, I will definitely be able to make some money. And if the market stays the same, I'll definitely be able to make some money before Friday's close. And that's what I'm looking for. I'm looking for before Friday's close. So today, if I'm going to give you some homework, for example, I want you to put together a pattern that you think is great. All right, because I had some of you send me some patterns that you thought were great in email, and they weren't, for a couple of reasons. Mainly because you have too many longs that you're trying to create these profit peaks with, way too many longs. And two is you're spreading out the shorts too far. Those are the main issues. And that's just basically a structural issue. You have to understand that you can't do it based on the risk graph, so to per se. You have to do it based on the relationship of the strikes, because different volatility during different market conditions is going to show you a completely different risk graph for all of these patterns. So you have to know what you're dealing with regard to the relationship and what causes issues to come in to the price projections. All right. So put together a trade that you think is great right now, today, before tomorrow's open. And then I want you to look at where that exact pattern is trading based on tomorrow's expiration. That's the process. Okay. So I'm going to put together, next week's trade, Friday, Monday expiration, put together a couple of strikes, a bearish trade and a bullish trade. And I'm going to do it based on purely the risk graph. I'm just going to look at the risk graph and I'm going to say, oh man, that looks really good. I'm not going to take into consideration, all the gotchas that I say you got to avoid. The too many longs, too far distance between the short strikes. Ignore all that. Put the next week's trade together, and then I want you to look at where that price is now and see if there's any profit potential. And there's probably not if you have too many longs and you have the shorts that are too far away. So, and in fact, you might realize that, oh, wow, if I put on this trade right now at this price, I could actually be losing money next week and not making money. And in some instances, you can't avoid that. There are times where that's just the way it's going to be. But we want to avoid those as much as possible. And when they do occur, we don't want to sit there and think that we're supposed to make $50 and we're losing $100. Those are the ones that you want to avoid at all costs, because that's just a huge swing in expectation. And those are the ones that are going to occur when you have too many longs and the prices, short strikes are too far apart. Okay. All right. So what am I going to do? I'm going to go ahead and put on this this bubble trade. And I'm going to do it at a credit. Let's see. 173, 157. So I'm going to go, this is order 7 and 8. And so I'm going to go order 7 and a credit of 175. And then I'm going to say, and this is in the money, so it's not exactly the highest probability trade, but for the sake of showing you how to place them. So order 8 was 175, 157. So I'm just going to go for a 15-cent credit. I'm going to be really conservative on this, and I'm going to say if order 7 is filled, then do order 8 and do it at a debit of 157. So actually, let me interject something here before I go too much further into this. The credit is one thing. It's great. It's tremendous. Wonderful. Love it. Fine. Perfect. Okay. The credit between these two is great. However, look at my bullish. How much profit potential is on this bullish? If I get it at a debit of 155, what's the max profit potential if the market skyrockets? $45. $45. So that's one reason I wouldn't want to place this trade in normal circumstances, even with the credit, right? I have a credit here of 171. What's the risk on this trade? 3 strike difference, 4 strike difference minus 171. It is $230. Okay, $230 is my risk on this. I'm only going to offset that risk by about $45. So in normal circumstances, I would probably put this on because this is at a credit of 171. Where is it going to be next week if the market goes nowhere? 117. And I'm probably the bullish 324, 322 is actually trading at a debit of 180. So that's actually at a profit, but I have a pretty high probability of being able to get this at a little bit better price. So that's probably what I would normally do. Again, I'm going to stick it at 155 for the sake of this call. This is why I don't necessarily, so 171. So I'll just go ahead and hit save on that one. All right. So we got that one working. Again, this is not necessarily how I would do it. I like trading these out of the money and getting a small credit and going out of the money with those. Again, because it is a credit, it is what it is. But I have a high probability of getting into this bearish neutral trade, and then on any move down, getting a better price on the bullish. So I could actually put in 130 on the bullish or 135 on the bullish as a debit, and I'd have a pretty high probability of getting filled. And if I don't, I'm only increasing my risk by $45 to the upside. If you're concerned about the risk to the upside on this particular trade because of the blueprint and the max risk on any trade, then you put it out of the money, and you do both. You make sure you get filled on both of these. Okay. All right. Let's take questions here. All right, per Monday, so I've been tracking my trades throughout the day. I've still been let's see here. So Ryan, I think you're the one. You sent me one of those trades. I have comments for your trades that I will be making, and I'll be sending you an email. Okay. I believe $1 million pattern on Monday at T is okay. So a lot of you saying, "Hey, I haven't seen a, I haven't seen a profit yet." That was before the call. Obviously, now they are also. Let's see, 323, 326, 327, 320. Okay, these trades were not, so the trades are not falling apart. I think that would be, so why did we not see a profit until basically the call, with the market moving down? It's simple. They just simply did not drop the volatility. So the bearish trades are out of the money, and they're still trading at a significant credit. That's when you know, okay, I'm fine with this trade. I do not. So what you don't need to do is, if it doesn't show a profit by Thursday, you don't need to panic by any long shot of the imagination. So if it's not, especially in the current situation, for example, if you're in the 323, 320, where is that trade? Let's pull this one back up here. So this one was in the money this morning. This trade was not showing a profit this morning, and we were trading, around 327 ish. So at that point, my bullish. So I had the 324. No. Where's my bullish? Order 4. So 331, 333, 331. That's my bullish. And then my other bullish is order 2, which is just my 320, 331, 329. So this morning, the 331s were still going for quite a bit. So I had a lot of room on this bullish trade. This was also trading at a significant credit. My bearish neutral is still trading at a significant credit when the thing was barely over my second profit peak. That's when I know, if I don't have a profit on Thursday morning and that's where we're trading, that's when I know you hold the trade. So that's not an issue. Okay, if you're looking at a $20 loss, there is no reason to get out of that trade. None, zero, zip, zero. None, zero. Because we're not anywhere close to the max profit zone. And so worst thing that can happen is that the market stays there and you end up losing $20 because some bizarre massive drop in volatility occurred before the major profit zone, but while you're still within the strike zones of this bearish trade. All right, so these are the things you got to think about. Why am I losing on this trade when it's still not even out of the money? Why am I losing on this trade? Look at the value of your 327 calls. There was a $1.60 at one point on the 327 calls this morning at the money, and it was at the money. So no reason whatsoever to get out of this trade early if you don't see the profit by Thursday morning. If you do see a profit on Thursday morning and it meets your minimum profit target and you're worried about that falling apart, then go ahead and take it. But if you're not, don't. Okay. Again, you guys got to be willing to accept the risk on the trade. And I think that's a mental block that some of you are having a problem with, is that because the trade is so high probability, you're like, okay, I'm not going to lose. I can't lose. I don't want to lose, or I don't want to lose more than $10, or I don't want to lose more than $20. No, you have to be willing to risk $150. There are going to be times where things just don't work out quite right. But the probability is, if you have a loss on Thursday morning and the market is trading within your profit zone, hold on. Period. End of story. If you have a loss on Thursday morning and you're past the profit zone, that's a whole nother story. Yeah, you can decide if it's only a really small loss, then I might decide to go ahead and get out, or I may get out of my bullish and take my big profit in my bullish, and then have a higher probability of seeing my bearish come down, et cetera, et cetera. Okay. If I have extra longs and can't sell them for a significant profit or sell calls against them for a reasonable premium, should I sell them early Thursday to prevent further time decay? Yes, if you have extra longs, you always have to be careful with those. The extra longs definitely can come back and bite you. So yeah, I would get out of them. How does the 98% pattern look to you this afternoon? Are you talking about this week's or next week's? So let's put together next week's. All right. So I'm going to go another trade. 723 $1 million option pattern. Okay. So let's bring this down here. And I'm going to get rid of that one. Okay. This obviously is old, so I'm going to refresh the data. So we're trading at, where are we trading at? We're trading at 322.19 now. So I'm going to go with a 323, whoops. Add order 323, 326, and then 327 would be that one. And then my bullish, I'm going to go 330 and 328. We'll see if we can, where the prices are at on this. So 161 and 91. Not quite where I would want them. These are really expensive. The bullish is really expensive for being, that far out of the money. So this would be 180. This would be like a 20-cent debit. Again, probability of that happening. So let's see here. I'm going to go 323. So I would do this. Order one, credit of 170. So I'm going to make the market move up to hit my price. And then I will go, if order one is filled, order two at a debit of 0.85. And I'll go two of those. That will give me my zero credit. Again, the risk on this one would be about a little over $330. And the risk on this one, if I were to just do one bullish to begin with, would be $90. And then I could go here and put in my bearish. I could do it at 160 and then put in another bullish at even cheaper. And that way I would at least create a credit, and I would still have a some negated risk to the upside. That's one way to do it. In fact, I would rather do it that way, to be quite honest. So let's do this. Let's do order two at a debit of 85. All right, I've already got one credit working, right? So I'll do a debit of 85 on that one, and then I'll say if order two is filled and execute order one. I'm going to do one at 85, and I'm going to do execute order one at a credit of 160. And then I'm going to say if order two, let's see, order one is filled via action group, order action group two, I'm going to execute order two again. And I'm going to go at a debit of 75 cents. Right now, this may be multiple days for this to get filled. And at any time, if it's not filled, if the whole thing is not filled, I have a profit. I always have the choice of taking the profit. All right. All right. So I'm going to turn that one on. Okay. Again, you have to be willing to take the bullish, one bullish as a risk. I got to make sure I only do one bearish and then one additional bullish. So I'll save that and turn it on. All right. About money management, it will take some time to reach 4,000 and for that seems hard to risk like an iron condor problem. Give me no, you are completely misunderstanding that. Let me pull up this. Whoops, let me do that. Why was that rejected? Do I have a different order in place? I may have a different order in place. So let me see that. Let me see here. Just off. And 1 second, I gotta figure out why that one was rejected. All right, so let's see here. Let me pull up the money management while I'm thinking about it. All right, so I just had to put it in a different account because of the conflict. All right, let's move up here. All right, so let's say you get to 4,000, you're trading 6, and you go to, you're trading 6, and you go and you end up suffering the largest loss on that. So the reason that this is put together the way it is assuming, and this is why I say you can't use this with anything else, it's assuming that you are putting yourself at a very low probability of realizing the maximum risk. And so while it is true, if you go up to 4,000 and you get to 6 and then you take a $900 loss, that you go right back down to 3,500, right? So you go to 3,500 and now you're going back down to 4, or you go, 3,100. So you go back down to 4. And then if you take another loss, right, another max loss, then you'll go back down to 2,500 and you're back where you started from. Well, this is very specifically designed in such a way so that it is, you're applying this to a strategy that does not have a high probability of suffering the max risk. All right. So if I put on, and this max risk, by the way, is your max risk. It doesn't mean you have to take a trade that is risking $150. So my $1 million option pattern is not risking more than $100 if it's filled, if the whole thing is filled, right? So the probability of you hitting that max risk is very small, even if it is filled. And so what's the probability of me getting filled on 2 of those, going through the profit zone, not taking a profit, and suffering the max risk of $100? What's the probability of that happening 2 weeks in a row? It's almost non-existent. I mean, it's just, it would be a bizarre situation that is there. All right, so if that does happen though, bizarre, and however small the possibility is, let's say you make a mistake on one and it happens that way. Well, so you're back to $2,500, okay? Where would you be if you didn't apply the money management and then drop back? You know where you would be? About $2,500, because you would not have made it to 4,000, and you would have still dropped back to about $2,500 based on the sequence of trades. So whereas, yeah, it could happen that way, you have to go through this process in order to get to the larger trade size, to where you get to the point of what I call is no return. And if this bothers you in any way, shape, fashion, or form, I'm going to strongly suggest that you go get the money management course, Fixed Ratio, at fixedratio.com, and you go through the entire course. If you don't trust what I'm telling you here, that's fine. I teach the entire thing in 12 hours. That's how much detail I put into this. So go to fixedratio.com and grab that. All right, so hopefully that answers your question. I mean, this is what we're designing. As for this, Michael, yes, as I mentioned at the beginning of the call, I got your emails. I just have not had a chance to respond yet. Okay, a lot of I've already answered a lot of these throughout the session. How often do I check my positions? Well, that's not fair, because I look at the markets all day long. How often should you? You know, morning and afternoon is fine. You don't have to watch these things. In fact, I would strongly suggest that you not, because you definitely tend to overthink them. And I'm telling you that from my own experience. You definitely tend to overthink them. Like some of you way overthought this. Why this morning was my trade still showing a loss? You way overthought those. And you thought, so if you were looking at the trades this morning, you're like, oh man, I'm at a loss. I need to get out. You know, you weren't thinking properly about them. You way overthought the situation from the standpoint of, okay, under no circumstances should I not be seeing a profit yet. When in fact, if you take a look and you analyze how much extrinsic value were in the short calls, you would say, okay, those are way over skewed right now. So let's see here. 138. So 70, 40, 20, 40. So let me show you one of my worst ones that was showing a loss this morning. This was showing a loss because it's 322, 325, 326, right? And at a credit of 138, it's now a credit of 88, and we're trading at 322.84. This is like at the money, not quite at the money. My 325 call, 73 cents. It's more than 2 points out of the money, and it's worth 73 cents. Okay, this will be at a debit tomorrow. All right, so I'm making money on this. My bullish is at 69 versus 49. That's $40. So I'm making $20. I was losing about $30 on this morning, because the market was trading above my my long strike. But this is one of the lower probability ones, because I pushed my bullish trade out by one strike, and that way, because of that, I was immediately able to get a zero credit. But it also means that I may have to wait a little bit longer for my profit. Or I may not even have a profit if it closes right at the dead zone tomorrow and I haven't gotten out by the end of the dead zone. But a little bit ago, this was actually trading at a $40 profit. And so I went from about a $30, $40 loss this morning to a $40 profit. But even this morning, again, there was still a lot of extrinsic value in, for example, this 330 call. A ridiculous amount of extrinsic value. And so now that's all come out, and that's a much better looking situation. Yeah, so you're not going to make as much on those for certain. And you may have to wait a little bit longer, but still, it doesn't negate the probabilities. And even if it doesn't work out perfectly, if everything works out exactly not perfectly, as in you haven't gone through the bullish zone, the bull zone, the profit zone, your risk is still just unfathomably low. All right. Do you consider these trades trade individually by itself or two? I consider them as a group, but I have to be willing to take the individual risk if that's how I choose to enter. How do I know when I should close your positions on Thursday or wait to Friday? If I don't have a profit on Thursday and I'm in my profit zone, I'm going to wait unless I've created a bad structure trade. Why can't you close the spread all at once? Because they don't allow you. I mean, I could get out both at market, right? So I absolutely could, but that's not the best way to do it. All right, let's see here. Would a three-legged trade on the bullish side be more efficient than a two-legged trade you've been recommending? If so, please give an example. Mark, I go over this in the seminar extensively. And by the way, it depends on how close they are. So if you have a bullish trade that's closer and it's only two-leg, it's going to be more efficient than a bullish trade that is further away and it's three-leg most of the time. However, as you get closer to the bullish one, as you get closer to the bullish profit zone in the three-legged one, you'll actually have a bigger profit. But leading up to that, you'll have a bigger profit in the two-legged one. So it's 6 of one, half a dozen of the other. And I would do which one I could get filled on first. That would be my determining factor. And I need to go in and see which one I was filled on first. Let's see, why would I do the bubble trade versus $1 million trade? You wouldn't necessarily do the bubble trade versus the $1 million trade. That's not why I was putting that on. And so it's one that offers a little bit more profit potential, but you take a little bit bigger risk. So is a bubble trade something that we can trade every week if the price is available? I don't put the bubble trade on at a debit, ever. Includes bearish credit spread early if you can get a profit equal to debit on the bullish spread. Mark, so you're close. So yes and no. If there's hardly anything left on the debit, on the bullish, then I would absolutely take my bearish and hold on to my bullish. If there's a lot of value left on the bullish, that means that you have a significant profit, and I would take it. Next call is on Monday, 2 p.m. Next week's call is not Thursday, it is Friday. I normally do them on Monday and Thursday, but next week is the seminar, so I do the live trade on Friday during the seminar. Is the bubble trade okay for beginners? DJ, yes, as long as you, I would watch it for a couple of weeks. You want to do it when it's out of the money, and I would watch it for a couple of weeks and always put on a credit before I actually take the trade. I did not say it was okay, guys. See, this is what I run into when I start bringing in different trades and whatnot. I did not say that it was better. There are benefits. There are pros and cons to each. So I was doing it as an example of a different pattern that can be traded. And by the way, I've still not been filled on my bubble. Where is that? Yeah, it's still not been filled on that one yet. So 175, we're trading at 160 right now on the bearish side of it. Anyway, yeah. If you're thinking, I said that one is better, that the bubble trade is better, then I'm not. The bubble trade has a higher probability of realizing a profit sooner if the market doesn't skyrocket. That's the benefit of the bubble trade. But you have a higher probability of risk, slightly higher probability of risk, and you have a higher risk. As the volatility drops, I want to bring those strikes in as close as I possibly can to give me a higher probability. Let's see. 324, 327, 328, and the 320, 332, 330. So you're going, where did I put that at? So 23, 27, 328. Your long is two, Tim, your long is two strikes above your bearish long. And I, under no circumstances, would put that on at a debit. Under no circumstances would I put that on at a debit. Okay, let's see. Thanks for your answer. You're welcome. Oh, you haven't had a chance to go through it. You bet. So go through it, and if there's anything that you didn't understand about my explanation, definitely let me know, and I'll be more than happy to answer those questions about the money management course. Shall I use the PDS Trader portfolio charts for monitoring our positions? No, there's really no reason to use the charts to monitor positions. You're better off just monitoring the positions, you know, on Trade Partner. All right, looks like I got all the questions, and I appreciate everybody attending. I will see you on Monday.